Good morning, everyone, and Happy New Year to you all. Thanks for joining us for our first charity update webinar of 2023. This, as you can see, is our charity finance update. I hope that's what you were expecting. I'm delighted to see so many people register and joining us live. Just before we do start, I wanted to confirm that we are recording the session, and we'll circulate the recording and the slides later in the week. So if you'd like to share those with colleagues that can't attend today live, then please do so. The webinar is going to be slightly longer than we've run in the past. We're going to be running for 2 hours. There's quite a lot for us to get through. However, we are going to pop a short comfort break halfway through. So you can, water in, water out. We've got 2 sessions where we're going to take questions, one after our first speaker and then one towards the end. I know you'll all be familiar with the functionalities of Zoom after using it for so long, but can I please ask that any questions that you do have, you post those as the speakers are talking. We do have everyone on mute, so you have to type in your questions into the Q&A facility. If you hover your mouse towards the bottom, you should see that. I'll be monitoring those questions and I'll ask the speakers your question at the appropriate time. And if we don't get through all of our questions, we'll come back to you later with a response. So I'm probably familiar to all of you, most of you anyway, if you've attended one of these events in the past, but I'm Jill Harpur and I head up the Charities and Not-for-Profit team at BDO. And today I'm joined by a great selection of BDO charity colleagues. So what are we going to be covering today? Well, first up, we've got an economic update from my fellow partner, Matthew Tate. Matthew is a partner in our business restructuring team. Matthew's going to share some reflections on the current state of the economy, what that means for charities, including some interesting highlights from some BDO research that we've been doing with a federated charity. And I will pause after that to take some questions for Matthew, so please do pop those in the Q&A. We're then going to hear from Robin Harwood, from our charity technical team, and Fiona Condren, one of my fellow charity partners, who will take us through financial reporting considerations, accounting and audit changes, and highlights from our recent charity retail tracker. And then we'll be having a comfort break. Following the break, we'll hear from Caroline Jones and Carol Anand. Caroline is one of our not-for-profit employment tax specialists, and Carol, charity VAT specialists. And I know they'll be familiar to a number of you who've been working with them. And they're going to take us through emerging issues in both of those areas and what you need to look out for. So without further ado, I'm going to hand over to Matthew for our first session.
Thank you, Jill. Hopefully everyone can hear me. Please, someone tell me if you can't. Good morning, everyone. My name is Matthew Tate. And the first thing I'm going to tell you is that I'm not an economist. As Jill said, though, what I am is a business restructuring partner at BDO, and I specialise in working with boards of directors, governors, and trustees through the various challenges that they face and that they have. So this includes supporting them through the personal risks that they might face, legal and regulatory, that do impact trustees and directors, but also then working with them to identify the options and implement strategies to secure the viability and sustainability of the entities for which they work. My experience then is working with clients facing financial and operational challenges, but there has to be context to that. So the current economical counter-cyclical environment, which is a euphemistic term, is just one of those challenges, accepting that it is at a macro level and therefore impacting an entire sector, a whole, and indeed an entire economy. Also, somewhat unusually, one of our forecast views is that it is going to be a sustained issue. So this short presentation has actually been prepared in coordination and collaboration with my colleagues Jyrki Kolsi and Tom Coleman in BDO's economic advisory team. That team's aim is to make economic data, forecast, prognostications, etc., real and hopefully usable. So if you'd like to know more about them, what they do and how we might be able to help, please don't hesitate to contact me. So for the next 10 minutes or so, I'm going to take you on a quick canter through the economy and how we think its volatility may impact the not-for-profit/charity sector. Clearly, and before I sort of start on the main presentation, There's no doubt we've been through a politically dramatic and unpredictable period, and that has fed into where we are, because the setting of Treasury priorities is one of the key objectives of politics, and importantly, they underpin business confidence and clearly planning. So only 7 months ago, Boris Johnson was Prime Minister and Rishi Sunak was Chancellor. GDP was modest, but it was positive. The Bank of England, the interest rate was around 1%, and in fact it was 1%, and statistically, and this is a highly unusual, first time I think in recorded data that this has happened, there were more jobs available than there were economically active people. I just want to sort of focus on that second part of that sentence, because the economic active is actually partly driven by a withdrawal from the labour market of a large number of individuals who've decided that they will not work and effectively either retire or scale back early. However, so just going to the slides, CPIH, which is the Consumer Price Index, including housing costs, which is our preferred measure for inflation, was already at about 9.5%. And this is, as I say, the Consumer Price Index, including owner-occupiers housing costs. So it had risen by 8.2% in the 12 months to June 2022, and up from 7.9% in May. So we'd already had this quite major inflationary shock. Then, as I'm sure we all recall, we had a brief experiment in supply-side growth economics. Of late, it has become much more settled, with a number of commentators calling that the grown-ups returning to the room. That's not my misstatement, that's someone else's statement. And that clearly that is led by the Chancellor, Jeremy Hunt. And the Chancellor has clearly and very publicly focused himself on two things. Firstly, the beating of the evil of inflation, and filling the budgetary hole of 50 to 55 billion as first recorded, caused by the economic shock of growth side economics. That's actually reduced down to about 30 to 40 million on current forecasts. Importantly, he is not, unlike his predecessor, targeting the anti-growth coalition. So there will be a long-term issue that will have to be resolved at some point. A principal reason that it matters, all of this matters, is because the contracting economy raises less tax, quite clearly, and when compared to other economies, which is the world in which we live, it is less attractive for future growth. For future growth investment. This then filters down into two main ways to the public. Firstly, they feel less confidence, so spend less. And they also tend to pay, there tends to be a pressure on tax. How you spend that tax can increase, which reduces spending power. It can also, I think they've abandoned the tax reduction policies of their predecessors. This clearly then feeds into discretionary spending, which includes quite obviously donations, gifts, legacies, endowments, both from the individual but also from corporates. One interesting fact, which I think kind of creates a context for the UK's economy and how we view it, is that of all the G7 developed economies, the UK economy is the only one that has not regained its economic position from prior to COVID. So as a starting point, the UK economy recession is marginally worse. Now, economists have attributed this anomaly to a voluntary labour market tightening that I just referred to, and resultant restrictions in supply chain interactions, causing a change to world trading status. In other words, there is sand in the gears of world trade. I think possibly controversially, or maybe not, that's probably due to Brexit. There is a theory that it only takes three economists to get the right answer. One says up, one says down, the other one says it stays the same. Unfortunately, at this time, all economists tend to agree that the pressure on cost of living is going to continue. The simple reason is that whilst Mr. Sunak has laid out one of the 5 matters to be measured by, which is the reduction of the growth of inflation, that inflation is going to become baked in. There are no deflationary factors sitting on the horizon. Looking at the slide, What we've done is we've looked at a broad basket of economic views and slightly adjusted those because they have improved very marginally since the last time I gave this presentation. The UK output is forecast to fall for up to 2 years. Bloomberg says it'll fall by about 1%, and the OBR, the Office Budget Responsibility, is forecasting up to 1.2%. A couple of things to say about that, which is banking economic forecasts tend to be more positive than central bank forecasts. And secondly, when you reflect back at those forecasts, when we look and compare those to post-recession review of those forecasts, they both tend to undercook the position. What we're seeing at the moment, which is clearly positive, is slowing energy prices, which is one of the major factors of inflation. And that will be presented in all likelihood politically as a success. However, what it will not do is impact or in any way reduce the increase in cost of living. So what we are considering there is expected further interest rates, which impacts absolutely everyone, and highly unusually, a long, shallow recession, expecting ultimately with inflation to reduce to about 2% by the end of 2024, so back within the BOE's, the Bank of England's target range. The depth and length of the recession is clearly uncertain. So on the right-hand side of the slide, you'll see what's called a fan chart, which gives a kind of a range of potential outcomes and a degree of certainty. One of the ways of looking at that slide is that the Bank of England is forecasting with 85% certainty that there will be a long and shallow recession. And that, with the government's focus on inflation, it is unfortunately unlikely to change. Just to highlight, that is actually highly unusual. Most recessionary periods are no more than around a year. Usually only 2 or 3 consecutive quarters, which is the 2 quarters is the definition of a recessionary period. So this is something which, again, broadly has not really been experienced before. We move to the next slide, please. So we have the cost pressures are likely to continue all the way through 2023 and into 2024. The continued high inflation is very likely, actually, but may lead, but I'm soft-soaping it. It will lead to upward inflationary pressures on wage growth. Clearly, the government's policy at the moment is to focus on public sector wages, and I think from a rationalist perspective, you can understand why they would wish to do so. However, wherever those settlements arrive, there will be a sustained and built-in wage rise gap between the cost of living and the effective living wage of individuals. Those are clearly going to be affected by the projected rate of interest, which, again, it's slightly softened over the last few weeks, which is a range which goes from around 4% to 4.75%. But the critical point there is, what does that mean to the person on the Clapham omnibus? And that is that the mortgage rate is likely what's called the effective mortgage rate, the value of available mortgage deals to the general public, will be implied at around 6 to 7%. And if we compare that with 2021, where the rates were around 1.5 to 2%. In real terms, that's an increase of around 60% of typical monthly mortgage cost. And we have actually already, it says the effect will bleed into the rental market. You may have picked up in the financial press earlier this week that it's already bleeding into the rental market, with rents on average going up. So those who are in tenanted arrangements are not protected in any way. Wage growth is going to lag behind inflation. Average weekly earnings growth around 5.5% in 2022. So it was already on an upward trajectory, but that was still half the rate of the inflation. So even as inflation comes down, which we are saying that it will come down quite substantially, the cost of living will be baked in, as economists say, so it will become real and permanent, but with no specific prospect of further wage increases to soften that blow to the cost of living. I'm afraid this is all sounding a little bit pessimistic, but I'm afraid it is what the economists are saying at the moment. Now, from a charities perspective, if donations and gifts are flat for a couple of years, a significant financial challenge combined with will relate to a significant financial challenge for charities, in fact, all businesses. Thank you. Next slide, please. So our research unit, the Economic Advisory Group, went back and had a look at various recessionary periods over time. And in contrast to recessions of the late 20th century, what we've tended to see is that when we enter into recessionary periods, there is a plateau in growth of charitable giving. And what we mean by that is that whilst the orthodoxy might be charity donations, etc., charity income actually reduces during those periods, actually it plateaus, it stays the same. The exception to that was the 2008-2009 recession. Just from a point of clarity, from my world, we don't truly view that as a true recession, even though the economic data states that it is. The reason that we view that is we differentiate it as a global financial crisis, i.e. it was a banking and money supply crisis, as opposed to the generality of the population feeling the impact of an economic decline. Also want to differentiate, as per the slide indicates at the fourth bullet point, that during the COVID-19 caused recession, what we saw there was very much a V-shaped recession. In other words, there was a sharp economic shock, which was caused by the pandemic. But importantly, incomes were largely protected. Savings actually increased to around an additional 330 billion during that period. And there was actually an increased focus on national giving. So the COVID-19 is not a great exemplar of what happens in recession. So what we have now is a recession that is forecast to be long and shallow, so effectively a slow grind, undermining confidence. The 23-24 recession is likely to, we think, is likely to see a reduction in disposable real incomes and a genuine fall in savings. So in other words, they'll eat up those that have accrued during the GFC, and also a partial restriction in credit, particularly if housing values drop, which many forecasts indicate that is going to happen. So I'm afraid our best forecast is that at best donations will remain plateaued or constant, but only in nominal terms. In other words, they'll be eaten away by inflation. So and the continued risk are downside risks. So further shocks to the economy could exacerbate that, and therefore income and revenue might be quite difficult to source. One of the things that I learned in the various studies that I've done is a kind of a key, simple way to kind of work out where public confidence currently sits. And there are, a general view, there are three indicators that I would recommend that people just keep an eye on. Those are unemployment levels, interest rates, and house prices. Unemployment levels broadly at the moment are very, very low. So we've got one of the lowest in Europe, one of the lowest in the world, and that is a positive indicator. However, I've already mentioned this issue relating to economic activity and those who are economically active, who have removed themselves from those numbers. And there is a broad estimate that unemployment rate will continue, unfortunately, to rise. It's currently about 3.5%, so which is incredibly low, and the forecast is to a range around 5 or 6%. Interest rates, I think, generally is already accepted, are continuing to rise. The government has stated that that is going to be one of its, well, it's actually the Bank of England will control that, but from a political perspective, that will continue to rise. That will be clearly bad for borrowers, but is also incredibly bad for public debt service costs, because that's the cost to the economy. And the market expectation is that we're going to end up at around 4.75% as the base rate. And I've already told you what that implies for a mortgage rate. House prices is the one which a lot of people in this country in particular are focused on. The OBR, I'm afraid, as the Office of Budget Responsibility, are, I'm afraid, pessimistic. In one forecast I saw, they were forecasting a reduction in capital values of housing by about 9%. Our view at BDO is that is slightly toppy, in fact, very toppy. And if you look at the number of the bank's economists, they don't see anywhere near that level, but still a reduction, which we are month on month. I think we're in month 4, maybe, sorry, it's month 7 of capital value reduction. Now, the thing to do with those 3 economic indicators is that if 2 are good and 1 is bad, then broadly speaking, public confidence tends to remain relatively high. But if 2 are bad and only 1 is good, then it tends to be declining in terms of confidence. The issue might come if we have 3 bad. There is, just to end up my short talk on this matter, there have been significant changes from a statutory perspective, whereby those entities who do face financial difficulty can now be supported through many more mechanisms than previously existed. They were all brought in during COVID under what was called the Corporate Insolvency Governance and Governance Act. So things like moratorium and restructuring plans, which is clearly a subject matter for another day. But it is clear that the government has already focused on ensuring that entities do have a range of support if they do face financial difficulty. So I think that's my time up. I'm going to end there and open up for questions.
Thank you, Matthew. That's great. If you do have a question for Matthew, just a reminder, please do post that in the Q&A function at the bottom of your screen. I've got a couple of questions that have come in, Matthew. So if I just kick off with the first one, given the current economic outlook, what's the one piece of advice that you would give us now to weather this storm?
That's a simple question and clearly a very important one. The one piece of advice is review your forecasts and review every single assumption in that forecast. What I've tried to present here is that there are such a range of different factors that are going to be impacting the economy, going back to fundamentally, in my view, root and branch, at an operational level, understanding your forecast is without doubt the first piece of advice that any entity, whether you are not-for-profit, charity, corporate, you should be doing. And we know from our relationships with lenders as well as private equity that they are requiring of that of their investee/lending counterparts.
Super, thank you, Matthew. And many of our charities that we work with subscribe to the Living Wage Foundation definition of living wage. Do you expect that many will be unable to afford that going forward?
Well, that's a big question. Do I expect many of them to continue? There is no indication that government policy is going to make that easier in any way. It is a policy objective for both of the main parties to continue focus on the living wage. We've already seen over the last day or so the Chancellor and the government confirmed that there's going to be a scaling back of the utility cost support for businesses. So that would indicate that actually the government has clearly stated that there just isn't enough money to do anything else to support businesses in that regard. The reality, I'm afraid, Jill, is yes, I would expect it to become harder because that's part of the kind of conundrum facing businesses who've got the cost of living. They'll acknowledge that within their staff base and themselves, and a request for higher wages causing sort of discord within entities. So yes, I do expect that to be a continuing issue.
Thank you. And a linked question with regard to unemployment. The challenges that charities have is that we're competing often with rates of pay against the private sector, and that's very, very difficult to compete with, even for some lower skilled jobs such as supermarkets. Any advice on how we could address that? Again, a tricky one, Matthew. Sorry.
That's fine. Yeah, I mean the competition between public sector, private sector, and third sector, not for profit, is sort of age-old question. this is not really an economics advice, but it's one of the reasons that I work within the not-for-profit sector, which is the degree to which an entity, a charity, can show and live its values in order to attract employees, because it has to frankly offer something that is slightly different to the standard employment offering. I think having a really clear focus on how you recruit via that objective, it is something which will differentiate yourself. Yes, I mean, if I go to the private sector, the corporate sector, one of the things that we saw from COVID is that a number of businesses that have, for example, taxi driving in London, so the kind of Uber driver, they all abandoned Uber and all took up jobs as in delivery. So there is a great sort of fungibility of employee bases themselves. And what the supermarkets were offering was certainty. And actually, what that cohort of employees found is they enjoyed that certainty. So they might have had lower overall income, but they enjoyed the certainty. I think for the not-for-profit and charity sector, having a clear objective of what makes you different is really the best thing that you can do.
Absolutely. And maybe we'll pick that up and just explore it a little bit later in Caroline's session. Question just come in. Do you see the GBP remaining weak and hence keeping the UK attractive to overseas visitors?
So can you say that question again for me, Jill?
Sorry. Do you see GBP remaining weak and hence keeping the UK attractive to overseas visitors?
Well, GDP won't directly influence visitors. It will clearly impact the degree to which investment becomes likely into the UK. The number one thing that's going to attract visitors is the weak pound. And so today, I think the pound was about 121 against the dollar and 133 against the euro. Now that is incredibly weak. Now we did clearly see it through Liz Truss and Kwasi Kwarteng's experiment that the pound value against major fiat currencies dropped really dramatically. It has regained every single cent and dime of that. There are no indications that the pound in any way will strengthen, and so therefore, from a visitor perspective, the UK is going to remain extremely attractive. Also, macroeconomically, it's going to make it UK assets very, very cheap. So you can see a move to it's already happened, a move to foreign ownership increasing in terms of UK companies. Good news actually for share portfolios and pension portfolios is most are described in US dollar, remain strong. So there's a bit of good news.
Yeah, we're starting to see that coming through with some of the valuations. How confident are we that inflation will fall as quickly as predicted next year? High inflation has been stubborn to reduce previously.
Economists won't sort of say to me, well, I'm definitely going to, I'm going to stake my life on that one. The degree of confidence is extremely high, and that's because the economic shock of Russia's invasion of Ukraine, the contraction of gas price and the flow around the world relating to sort of just normal trade flows. Those are all easing. I think the downside clearly is one of the reasons that gas prices are falling is because usage is falling. So in terms of the total cost to the consumer is going down because we're just basically using less. Good news in places like Germany, who've restored their gas storage facilities. They're at about 85% of their standard. And it has forced actually Europe to make some significant changes as to its supply arrangements. Now, if you bake all of those things into your forecast, and you say that utilities are actually one of the major costs of inflation, and indeed they are, those are baked in and are coming down. And you can see that not just in gas price, you can see that in fuel oil price, which you'll notice at the pump price, that's dropped from an average of around 171 per litre down to 155 per litre. If you're in certain parts of the countries, it's even lower, particularly if you live near an oil terminal. But it is so. I think the degree of confidence that it will reduce is incredibly high.
Super, thank you, Matthew. Charity retail. Lots of our charities that we work with are reliant on that source of income, and obviously, because of the restrictions of COVID, that has been somewhat suppressed in recent years. Do you have any views around how that will hold up during the economic downturn?
I think we might reflect more carefully and more specifically on charity retail, because there are so many dynamics of that specific subsector which don't necessarily play out with the usual footfall and like-for-like measures that we would use economically and within BDO when we're talking about retail.
Yes.
Clearly, there is going to be, if cost of living is going down, you would expect charity retail, particularly those who are focusing on sort of clothing, shops, etc. You would expect actually that to increase, and that's a form of donation that is not going to be really impacted by the cost of living, because those are things that people already own. Do I have any specific views about it? I would say I'd be a bit more careful about that, because I haven't got the data to indicate to me. I think the logical sense would be that's going to be a specific area where it will plateau and possibly increase in terms of like-for-like sales. The issues that you've got with retail, again, is if you are paying for your staff to be in there. I know that's not always the case. Then clearly there are some wage inflationary costs, so your margin levels may reduce, notwithstanding. Yes. But I would be broadly positive about the retail sector within charity specific. In the standard high street, I'm a lot less positive.
Yeah, agreed. And I think, you know, some of the challenges that we've seen for charity retail is around supply and, you know, getting the goods through the door to be able to then sell on and hopefully increase those income streams. Super, thank you. You mentioned, I think, in your presentation that donations are likely to fall. Do you think that will be proportionate across all sizes of charities, or will smaller charities suffer more than the larger ones?
That again, it's another tricky. So this is going to be an opinion-based answer. I suspect that yes, smaller charities will more likely proportionally suffer more from that fall. And that's to do with strength of balance sheet, ability to access a wider public group with a broader objective, and less community-based. So therefore, you would expect it to be very regionalised, depending on how region do I think you expect that, you know, the southeast and the the northeast to be identical. I suspect very strongly not. So I think my kind of personal subjective view, based on my knowledge and working within the sector, is yes, smaller charities are more likely to suffer that reduction than larger charities. And in particular, actually, I think what I would add to that, which is one of the factors of larger charities, is their access to corporate sponsorship, which so again, as businesses themselves are struggling with the same issues that the not-for-profit sector is struggling, whilst I will also see that to reduce, they will very likely, from a CSR perspective, still maintain significant contributions to charities. Now, that's something if you're in a local business, a local charity or a smaller charity, and you're relying on local business to contribute, their issues are actually much more direct, and they don't quite have the balance sheets to ensure the CSR. Indeed, they don't have that as the forefront of their thinking.
Really helpful. Thank you, Matthew. That's been really helpful. Thank you, everyone, for your questions, and thank you, Matthew, for your session. If you do have any further questions, Matthew will remain on the webinar with us, so we'll have another Q&A towards the end, just in case anything does spring to mind. So our next session is being presented by Robin and Fiona, and I'll hand over to Robin to kick us off for that one. Thank you.
Thanks, Jill. So Jill said, I'm Robin Harwood. I'm from BDO's technical accounting and reporting team. I specialise in the charity sector. If we can just move on to the next slide. So this session, we're going to cover a number of areas there. So we'll kick off with some financial reporting and narrative reporting updates. The good news is that that's going to be pretty brief for this reporting cycle, but there is more coming on the horizon for future years, so we'll touch on that as well. I'll then spend a few minutes talking through some couple of sort of key focus areas to have front of mind when you're preparing and reviewing accounts for this year. Fiona will then run through some updates to auditing standards that are now effective and what this means for you. So in terms of UK GAAP, there have been no changes to FRS 102 for this reporting cycle, so very much business as usual from that perspective. The FRC have kicked off their next triennial review of FRS 102 and released an exposure draft which sets out the proposed amendments to FRS 102 just before Christmas. That's FRED 82. The main proposed amendments in there are in respect of a new model of revenue recognition in line with a five-step model that's in IFRS 15, and a new model for lease accounting, again broadly aligned with IFRS 16. That principally proposes to bring most operating leases on balance sheet. The FRC are currently running a consultation on the proposed changes. They're inviting comments through to April 2023. The effective date is itself subject to the consultation. They are proposing periods, the changes will be effective for periods commencing on or after 1st of January 2025. So really we're looking at December 25 year ends onwards for those changes. Just click on to the next slide, please, and one more. So in terms of the charity SORP, very similar story here. So no changes to the SORP, no new information sheets or accompanying guidance has been issued by the Charity Commission this year. We've just set out on the slide there the existing 6 information sheets, but they were all in place and effective in previous years, so no changes there. The example accounts for the current version of the SORP remain on the charity microsite, so it's a useful resource which hopefully many of you are familiar with. There were COVID specific versions included on there, and they remain there as well. In terms of the next version of the SORP, we do expect that to coincide with the amendments to FRS 102. The review of the SORP will cover other areas, so charity law, existing content from the SORP, as well as the changes incoming from FRS 102. But would expect that the effective date of that will be aligned to the changes in FRS 102. So likely to be periods commencing January 2025. In terms of narrative reporting, as I say, there have been no changes to the SORP that impact front end of the trustees report. There have also been no changes to company regulations. So for those of you with charitable companies that impact mandatory disclosures that weren't there in previous years. But one area I did just want to pick up is around on narrative reporting, is around climate related disclosures. I think this is an area where there is increasing focus on ESG disclosure and the long-term sustainability of organisations. If we kind of look at the context from the corporate world, last year saw the introduction of reporting based on TCFD recommendations. So TCFD is the task force for climate-related financial disclosures and provides a framework around climate-related reporting, covering areas such as strategy, governance, risk, as well as sort of reporting around sort of emission type metrics. That framework is in place for listed premium listed companies. It's now for standard listed companies, and from April, or periods commencing April 22, it now applies to large private companies very large private companies, I should say. So those with more than 500 million of turnover and 500 employees. Clearly, there will be very few charities that will be captured within that threshold. That said, I think we do anticipate that stakeholder interest in this area, in terms of the impact of charities on climate and the wider environment, but also the impact of emissions targets, net zero commitments, etc., on the charities. So we do expect the stakeholder interest in these areas will continue to grow. Not necessarily applicable to all, but we do expect that some charities may look to voluntary or further voluntary disclosure beyond mandatory requirements that are currently in place. If that does apply to you, the TCFD framework is definitely worth considering. The other area that wanted to pick up was around net zero disclosures. The FRC towards the back end of 2022 issued a report on net zero disclosures. That's really focused on what stakeholders expect in respect of companies that are increasingly making commitments around greenhouse gas emissions. If you're a charity that is looking to do something similar, whether it's net zero commitments or otherwise, then that's really useful reading. I won't go into the detail here, but it does run through things like commitments. What is the level of the organisation's ambition? What is the nature and timing of its commitments, and the impact? So how are commitments? How do those commitments impact an organisation's strategy? Its business model? What is the impact of transition plans on things like risks and opportunities, and indeed performance? So let's say you're making a net zero commitment to 2050. What does that look like in the short, medium, and long term? How is performance being measured and accountability being ensured? But just to take a step back from all of that, the mandatory requirements that are in place for large charitable companies from the streamlined energy and carbon reporting, those requirements are unchanged for those charities that applies. It's been in place for 2 or 3 years, 3 years now. So from a mandatory reporting perspective, there hasn't been anything that has changed, but I think this is an emerging area that will be applicable to many charities. Just moving on, just wanted to touch on for a few minutes a couple of focus areas to have in mind as you're whether it's preparing or reviewing accounts this next cycle. So the first one's cash flow statements. So why cash flow statements, you might ask, given that there's been no changes to reporting requirements, accounting frameworks. I think cash flow statements is an area, if we look at our own audits, we frequently see errors such as misclassifications in the cash flow statement. So I just wanted to highlight some of the fundamental principles. Similarly, I suppose the FRC issued their annual review of corporate reporting, which came out in October. That does focus on the largest premium listed entities and sort of improvements that those organisations should focus on in their reporting in the coming year. But interesting cash flow statements is now the #1 findings area in terms of the frequency of errors that the FRC have identified. So I think this impacts a wide range of organisations, right from the largest down to much smaller entities as well. So if we just flick on to the next slide, please. one key aspect, I suppose, that on the face of it can seem straightforward, but is often an area of confusion, is what is actually included within cash and cash equivalents for the purpose of the statement of cash flows. So more specifically, what actually is, what do we mean by cash equivalents? FRS 102 defines cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash and subject to an insignificant risk of changes in value. Bit of a mouthful, but what ultimately that often means is that the cash, a bank figure that you have on your balance sheet, may well differ to what is cash and cash equivalents on your cash flow statement. And if that's the case, a reconciliation should be disclosed. So what are some of the pitfalls, I suppose, to look out for? If we just flick on one, please. So the treatment of certain deposits. FRS 102 states that deposits with a maturity of more than 3 months from the date of acquisition will not generally meet the definition of cash and cash equivalents. The date of acquisition is really important. So if I just give an example, if you've got a deposit that at your year end has 2 months to maturity, but you took that deposit out 4 months previous, so the total term is say 6 months, that will most likely not meet the definition of cash equivalents because the date of acquisition is more than 3 months. In terms of other areas that we see commonly, so the inclusion of non-cash items within the statement of cash flows, so they should be excluded. Cash flow misclassifications, to ensure that you're familiar with the definitions in FRS 102 of operating, financing and investing cash flows, and that they are applied consistently. And then the final bullet there is on gross and net presentation. So for gross presentation, we often see amounts presented net where they should be presented gross. So a couple of examples might be if you've got borrowings, so you've received new amounts of borrowings and made some repayments, so they should be presented gross. And similarly, if you've got investment assets, investment cash flows, if you've got separate additions and disposals, those cash flows should be presented gross rather than net. The second area that I wanted to pick up in terms of focus areas is the financial reporting implications of the current inflationary environment. Just following on from Matthew's session earlier, the bit I just want to pick up here first is around considerations of where there's volatility in exchange rates. This isn't a one size fits all, but if you are a charity that has transactions in foreign currency, perhaps those transactions fluctuate across the year. So whether that's the volume of transactions, the values attributed to them, and perhaps you apply an average rate, average exchange rate in translating your foreign currency income and expenditure and transactions. If that's the case, so under FRS 102, we are permitted to use an average rate to translate foreign currency transactions, provided that rate approximates the actual rate on the date the transaction is entered into. The volatility in rates may well mean now that a simple average rate, whether that's an average rate across the year, across a month, might not be appropriate. Let's say that will depend on the individual circumstances, the size and volume of transactions and spread across the year and so on. But it's what if you have have been using an average rate, you should consider whether that remains appropriate in line with the movements in exchange rates. So just to think about some of the implications of rising inflation from a financial reporting perspective. So firstly, in terms of the financial statements themselves, we've included 4 areas on the screen here. These are not by any means intended to be an exhaustive list, but I think to provide a flavour of some of the areas that you should consider. If I start on the top left, so cash flow forecasts. So I know this just follows on from Matthew's session earlier. But cash flow forecasts clearly prominent in things like impairment reviews, concern assessments and forecasts. So you should consider how they will be impacted by inflation, whether that's the demand for services, the pricing of those services, increases in cash outflows as prices increase. Secondly, committed cash flows. This is principally an onerous contract provision consideration. So if you are a charity that perhaps has fixed income contracts that have been negotiated in previous years, and the costs that will be required to deliver those contracts have increased significantly as a result of where we are in terms of inflation, you should consider whether there are any risks there of loss-making contracts, in particular contracts where they cannot be cancelled without paying compensation. If that's the case, you may be in a position where onerous contract provisions need to be recognised. In terms of valuation, so first thinking about the direct inputs. So if you've got valuation models, input assumptions around discount rates, growth rates, income yields, and so on, are likely to be impacted, which will have a direct impact on the actual valuation numbers. If you have defined benefit pension plans, similarly the actuarial assumptions, so movements in interest rates are likely to impact discount rates. Assumptions around future salary increases may well have changed with expectations. So all these sorts of things need to be considered when you're looking at balance sheet valuations. So in terms of the indirect effects of valuations as well, the general market sentiment, market sort of expectation of risk may well have also moved from where it has been previously. So the market's view of what is a safe asset is changed. That will then flow in terms of indirect effect on the valuation to reflect in the asset value at the year end. And then just thinking about the front end, so trustee report disclosures. Again, what I've sought to put on the slide here is by no means a sort of complete or exhaustive list, but just some areas that are examples of what you may wish to consider, which may be applicable. And again, this would vary very much depending on an individual charity and its individual circumstances. But if I just run through a couple of these, so going concern and cash flow forecasts already touched on, but I think you also may want to consider things like reserves policy. So have your trustees, has your trustee board reconsidered its reserves policy in the year? How is the charity, what is the charity's position against its reserves policy? is the trustee group undertaking actions to perhaps bridge any gap between the reserves position and the reserves policy? These are sorts of things that we would expect to be reflected in a trustee's report. In terms of changes to risk profiles, so if there are changes to risk profiles, we would, or indeed the significant risks that appear on your charity's risk register, would expect that to be reflected in the risks, principal risks and uncertainties disclosure. And in terms of stakeholder relationships, this does sort of dovetail into Section 172 statements for the large charitable companies amongst you. But think about how the charity is engaged with its key stakeholders in the period. To your employees, your funders, your beneficiaries, your suppliers, and so on. And how has it taken those interests, which might not necessarily be aligned to one another? How has it taken those interests into account when affecting key decisions in the period? The final point I would just make on disclosures is I would focus on and distinguish between what is a clear sort of specific direct challenge to the charity's objectives, operating model, versus, I suppose, broader commentary on general economic uncertainties. I think the more specific, more relevant the disclosure in the front end, the more useful it will be to readers. So at that point, I will hand over to Fiona, who'll pick up on audit updates.
Thanks, Robin. So as Jill said at the beginning, my name is Fiona Condren and I'm an audit partner here at BDO, specialising in working with charities. I'm just going to give you a very brief overview up to the break on a couple of developments that are happening, more on the audit side actually. And I suppose on a starting point might be, well, why is that relevant to us? We are the entity that's being audited rather than the auditor. But I think in both cases for these new standards, there are some really interesting perspectives on what the entity itself could be doing that will help facilitate what we have to do, but also to provide better quality information that's relevant to running the organisation anyway. So hopefully you'll see it from that perspective. The first one I want to talk about is the auditing standard that we now refer to as ISA 315. So it existed before, but it's been revised and relaunched. And this is the auditing standard which requires us to consider and identify risks of material misstatement. It's more than a tweaking of the old standard. It is basically a complete rewrite of the standard. And if you ever do suffer from insomnia, you can go ahead and read it. It's 181 pages, just to forewarn you. The changes are effective for periods beginning on or after the 15th of December 21. So in effect, it means that we are gearing up to deliver our audits against this new standard for December 2022 and beyond. It doesn't have any size criteria, so it is relevant for all entities of all sizes as long as you are subject to a statutory audit. So whether it's that audit's being conducted by BDO or another firm, you will experience some interaction with your auditors, which is framed around the impact of ISA 315. As a firm, BDO has taken this as an opportunity to completely refresh and relaunch our own methodology, which is delivered by BDO International. So it makes sure that everything that we now do is fully compliant with that new standard. So just moving on to the next slide then, just a summary of these changes which the standard brings in. The slide is relatively self-sufficient, I think, in terms of it setting out what these are. And I just wanted to really sort of bring to life, I think, some of the changes. So I think in the past it could have been, auditors could have been accused of having quite sort of vanilla based risks. Something's either a risk or it's not a risk. And this new standard is all about introducing a much broader spectrum of risk. So I read one article where people described it as the colour of risk is much broader. And I think that's quite a nice way of thinking about it. So we have to think about, in our assessment of risk, things like the subjectivity elements, any complexity in any areas, uncertainty, change, and really importantly, the susceptibility to misstatement due to fraud. And that's the second standard that I'm going to come on to talk about in a few minutes. And the other important thing on this slide that I wanted to reference is the fact that there is much more focus now on the IT environment and IT general controls. And this is the first time an auditing standard has actually referenced cybersecurity within the requirements of auditors to consider. So you can already see that the scope of what we have to think about is sort of increasingly getting broader and broader. And even if you have a relatively uncomplex IT environment, there'll still be a basic level of understanding that we need to gather around how that system has been established and the protocols, etc., that you've got in place. So just moving on to the next slide, thank you. So really, what does this mean for you and for us? Well, for us, it's a time element for us, and it's the timing of the resource that we spend on the audit. So if you've already started your audit planning with us, you may have experienced sort of more time being spent at that planning stage, because it's about the risk identification, being more granular and therefore needing more time at the starting phase of the audit. Because it's very judgment based around the spectrum of risk, what we're increasingly finding is that it's the audit partner and the manager that are effectively pulling together that final assessment and making those judgments, because they have such an important impact then in terms of the way in which we conduct the audit. So junior time will still be spent in terms of gathering information, but actually it's the final assessment which is taking more senior time. But on the plus side, what we are anticipating is that we will have a much more focused audit. So there may be areas where we do more work, but there may also be some areas where the spectrum of risk has allowed us to reduce the risk factor that we've previously identified for a particular area of the audit, and we may therefore do less testing. For you as the audited entities, you can expect us to be asking you more questions and asking for more information at that planning stage, and therefore, we may need to speak to people that we haven't typically spoken to outside of the core finance team. So people within IT, almost certainly legal, project managers, etc. And we hope that, and obviously we're looking for your feedback in due course, that you'll end up with a more robust and more tailored audit. I think the main piece of advice that we're asked for when we talk to audited entities about this is, what can we do as an entity to help you deliver this new standard effectively and efficiently? And I think the key piece of advice we need to get across is that we are looking for you to have already gone through that process of identifying each of your transaction and processing streams, right the way through from initiation to how transactions get into the financial statements. If that is something that you have already got documented and it's current, so it is reviewed and refreshed on a regular basis, then it does give us a much better starting point for our work. In some organisations that's a narrative, and in some organisations it's flowcharts. We do work with organisations who have got good financial control programs in place, so that that it is written down as to what the controls are, but sometimes we find that they don't perhaps extend as wide as we need, as I say, from that initiation phase right the way through to how things end up in the financial statements. And similarly on the IT environment, even if you've got a very simple IT environment, the IT general controls that we expect to be able to evidence, it would be helpful if you had been able to sort of pull that information together beforehand, because we're looking for things which are really best practice around making sure that we've got the right users are given the right access rights, etc. And how can you demonstrate to us that we don't have lots of super users or people that are left on the system after they've left the organisation, etc. So that's all on 315. So the second standard I just wanted to talk about is the new auditing standard on fraud, and our responsibilities relating to considering fraud throughout the audit. I think the key thing to reference here is that this is not about removing the responsibility from directors and trustees for their responsibilities in terms of designing an effective control environment which could reasonably detect material fraud. So that requirement and those responsibilities still lie with the organisation, but this standard seeks to put in place more focus on what we as auditors then need to think about as part of our work. And you can clearly understand that this is a response to the number of high profile frauds in the corporate sector over the last few years, where there's ongoing reviews as to what failed in the process of the audit and the audit entity identifying these things earlier. I think the second or third from the bottom bullet point there about professional scepticism, that's a cornerstone now of what the regulator needs us to demonstrate in terms of our focus on the audit, is making sure that we remain sceptical throughout the process, and looking at sort of contradictory evidence as well as corroborative evidence. And we will be speaking to people beyond the core finance team when we're looking at kind of where the risks of fraud lie. I think a couple of other things I would just mention here is that you may have been aware that BDO ran the charity fraud survey before Christmas, and the results of that really do indicate that unfortunately there continues to be a high level of fraud within the sector, and it's no different from the private sector. And when we talk about fraud, we're not just talking about cash leaving the entity. There's actually a really broad spectrum of things which fall under the definition of fraud, everything from manipulation of fund disclosures, so sort of putting things in restricted that should be unrestricted or vice versa. You've got obviously asset related fraud, grant applications, as well as the traditional sort of income and expenditure. But also from our perspective, we are looking for the risks of financial statement fraud, so the desire to present your results in a way in which is misleading or inaccurate in terms of how they should be presented, because there's another motive, whether it be to enhance fundraising opportunities or present a different view of how the charity has performed. So again, as an entity, you can expect to for us as auditors to be asking you more questions about fraud. And the last piece of advice I would give you is that typically we don't find that there's an awful lot of information written down within the organisations that we audit around how they've assessed their own risks relating to fraud. So I would strongly encourage you to make sure that at least annually you've done that stand back yourself and actually documented your own assessment of where are the vulnerabilities within this organisation to fraud. If you think about the trustees' responsibility statement in the accounts, it clearly says that the trustees have taken responsibility for designing an effective process of internal control, and therefore being able to demonstrate that you've thought about fraud and what your mitigating actions have been and controls that are in place is clearly very helpful and very important. So moving on to a completely different topic before we stop for a quick break, I just wanted to reflect on the current results that we're seeing within the charity retail sales tracker, and I'm delighted to say that Matthew was completely on brand when he talked about, or on topic I should say, in terms of his instinctive response to what's happening in the retail sector. If you're not already familiar with it, just by way of a bit of background, BDO runs the charity retail sales tracker on both a weekly and a monthly basis, and it mirrors the trackers that we run for the commercial retail sectors. So we're basically monitoring like-for-like sales of donated goods and gift aid from a number of different organisations who submit their data to us, and as a result you get that benefit of seeing how your performance compares to others in the sector on an anonymous basis. And FDs can also access a monthly report which is sort of designed particularly to pick up the key things for them. So if you are a charity retailer and you're not already accessing this information, then please do drop me a line following today's session, and we'll make sure that we hook up with you to find out if there's something of interest to you. But fundamentally, this slide and the next slide was really just to reiterate and bring together, I suppose, what we were saying earlier about the fact that, yes, there is an economic challenge for charities at the moment, but actually the statistics are showing that the retailers are really outperforming the sector, and it's really heartwarming to see that this is actually a really positive way in which charities can help to generate both funds for the organisation, but also often retail is used as a point of advocacy to, connect with more people to explain what the charity does. So the headline for the last 2 weeks of the year, 18th of December and the following one, which was the Christmas week, is what a positive end to the year it was. We clearly hope that charity retail will continue to do well going into 2023, we will be running more events, particularly related to charity retail, to give you an insight into how that is continuing to flow through. But you are also very welcome to join our high street updates as well, which gives you a bit of an insight into what's happening more broadly within retail. So that's all I was going to cover for now. I think I'm handing back for Jill, who's going to take you into the comfort break.
Thank you, Fiona and Robin. And thank you for the questions that have been posed for the Q&A. So we're just going to take a very short break. If I can ask you to be back for, let's go for 12:25, and we'll commence with our tax update at that stage, and then we'll take questions for both Fiona, Robin, and our tax colleagues at the end of the session. Thank you.
Welcome back, everyone. I'll move us into our final two sessions of the webinar, and firstly hand over to Parul for our VAT update. Thanks, Parul.
Thanks, Jill. Good afternoon, everybody. I'm Parul Anand, Director specialising in advising across the not-for-profit sector on VAT issues. Now, in preparing for this update, I took the liberty to look back through what updates had happened in 2022. And the common theme that runs through the VAT updates is this issue of when charities should or should not charge VAT or claim reliefs. Now, the theme runs through several aspects of VAT, including the legislative updates, the case law, and the business briefs. Some of these are in the sector's favour, whilst others require more detailed consideration. Now, in terms of the first of these, this is a legislative change which relates to the zero rating of the installation of energy-saving materials in residential buildings. Now, this is going to be of specific benefit to housing-based charities, and it's a time-related relief which is available up to the 31st of March 2027. I think what's interesting about this change is that it reverses the impact of EU legislation following infraction proceedings in 2019 taken by the EU, which forced the UK at that time to limit the relief to very specified circumstances where certain social conditions were met and where the service element of the installation was at least 60% of the cost. Now, the UK have removed these conditions, which makes it available for more to use. Now, I think it's really interesting because it is evidence of the government's ability and willingness to extend zero rating post-Brexit. I think whether there is more of this to come, particularly where the right policy drivers exist, we'll have to wait and see. But good news nevertheless. The second item listed here relates to, I think, the change in the way services are delivered, and there's no doubt that more charities, and in fact across any sector, there is a move to provide more digital services, and that means services beyond the UK territory. And this is, given it's an international issue, charities do need to be aware that countries are increasingly imposing VAT registration requirements for non-resident suppliers. And this is particularly where they're providing B2C digital services. Now that's business to customer, so to private individuals. And typically this in our sector will relate to downloads of recordings, publications, and items like that. Now, specifically, Norway and Singapore have introduced those requirements from the beginning of this year. So the advice here is to review, one, whether those activities are being carried out, which countries they're being carried out in, and whether the level of those activities are triggering registration requirements. Next slide, please. Thank you. So in terms of the next issue, I'm going to just focus on the other HMRC updates to start with, because they also represent good news for the sector. Now, post-Grenfell, many of you will be aware that housing providers were lobbying for the zero rate on the replacement of cladding and fire safety works, but the government did not provide that. What is good news is through sector bodies, HMRC have granted informal agreement that works can be zero rated if they form part of snagging works. Now, helpfully, HMRC have not defined or imposed a time limit for when those snagging works need to be carried out. So the availability of the zero rating needs to be determined on a case-by-case basis. Now, yes, it doesn't capture all cases, but this is a really good example where we see joint working between sectors and HMRC providing flexibility and working towards a solution that at least moves the issue forward. So some good news there. Secondly, you'll see that museums and galleries are being invited to apply for the VAT refund scheme. Now, there are certain windows, and this isn't available at all times, but applications are being invited for those museums and galleries that do provide a free entry. Now, subject to certain criteria being met, what this will allow is then for those organisations to reclaim VAT on the costs of providing the free entry, etc. Now, that's open until the 1st of March 23, so applications need to go in by then. It's a really valuable scheme. I mean, this was introduced first back in 2001, and since then, it's estimated that 1 billion in VAT has been refunded. So good news there if it applies. Just moving across the page to RCB 10. Now, this is Revenue and Customs Brief 10 of 22. Now, this is an area that requires the sector to be more considered in its response and analysis of what this particular brief means. So this addresses and announces HMRC's update in policy on when and how HMRC determine whether an activity is a business activity and therefore potentially within the scope, or non-business and then therefore outside the scope of that. Now, this brief singularly, I think, is the one that cuts across the sector very broadly. Now, what this brief does is it replaces 6 old tests that were commonly referred to as the Lord Fisher test that many of you will be aware of, with 2 new questions or 2 new interpretations of questions that HMRC believe should be asked by any charity or organisation when they're carrying out activities. The first is to determine whether the activity is performed in return for consideration. Now, normally that means money, but definitely not a grant. So you need to determine whether what you are receiving is a commercial income for cash or a grant. If the answer is yes, it is an activity in return for consideration, the next question to consider is that remuneration? So the question arises, well, what does remuneration mean? And HMRC have defined that as saying, well, is the activity undertaken for the purposes of obtaining income? And that does not need to be the primary purpose. Now, this is a big change from the historic tests, along with the point that they raised, that is you don't necessarily need to have a profit motive to be in business. Going through the HMRC guidance and the manuals is quite important, because within them you'll see subsidiary factors that you may want to consider. And here, I think what's interesting is you see that even if you are offsetting costs, or even if the income is lower than cost, slightly lower than cost, you can still be in business. And this comes back to the profit motive here is not the driver. The other interesting point that they raise is when you look at whether you're in business, are you operating in the marketplace? And that is the definition of competition as far as HMRC are concerned. And that competition does not necessarily mean in competition with other commercial providers, but can be in competition with charities or local authorities. So what this is leading to is, look, what's the impact if you lose the non-business treatment of the activities that you're carrying out currently? Well, the consequent impact is the loss of reliefs, in particular relevant charitable purpose relief, which, if lost, can trigger a requirement to pay back significant amounts of VAT if you've claimed that relief on building costs. Also, in terms of operational issues, if the costs then relate to a business activity that is exempt from VAT, it's likely to increase costs. So what that's likely to do is require you to go and really review all your activity and contracts and ensure that any grants that you've had in place for several years actually still stand up as grants, and any new contracts or new business activities that you're carrying out, you really are clear on what the VAT treatment of that is going to be. And I think historically, if you believe the VAT treatment's changed, I think one of the areas that you need to address is if the activity has become taxable as a result of the new tests, are you then able to go back and collect the VAT from your customers? Now, the exposure at this stage, we believe, should be restricted to the 1st of June 2022, but there are questions as to whether it could go as far back as 2018, when the case law to which HMRC are responding was settled. It's fair to say in the last 6 months or so, we've seen increasing HMRC activity around this area, and not only in terms of whether there are non-business activities, but if you are carrying out business activities, whether input tax is recoverable, because they seem to be non-business activities on the face of it. The first case here is the Towards Zero Foundation case. And here's an example of HMRC challenging the input VAT recovery on an activity that they consider to be non-business. Now, this charity carried out safety tests on cars and published the results. In those circumstances where specific manufacturers failed the tests, what typically happened was that once the issues had been resolved, the manufacturer would come back and pay the charity to retest and republish the results. Now, in this example, HMRC had blocked the initial VAT recovery on the free testing, the upfront testing, on the basis that no cash had been collected, there was no consideration, therefore was a non-business activity. This court, the first tier tribunal, found in favour of the taxpayer on the basis that they held that essentially the free activity, the initial and subsequent activities, were all part of one activity and should not be separated, and therefore all business and the VAT should be recoverable. And I think this starts to illustrate some of the questions and the areas that HMRC are testing in terms of trying to classify whether something is business, non-business, how the contracts are structured, held out. But this gives charities the scope to revisit the VAT treatment of their free activities that are designed to lead to paid activities and subscriptions, because I think where they've been blocked, there's definitely scope for that, for claims to be considered. In terms of administrative updates, it's clear that VAT, I think, continues to be the test bed for HMRC rollouts. The new VAT penalty regime being the case in point. Now, this has come in from the 1st of January this year and introduces a points-based system for late submission of VAT returns and late payment of VAT due. Now, what is interesting about this is that there will be no penalty now for late payment of VAT up to 15 days. Now, penalties raising from 2% to 4% apply thereafter. So arguably, it's slightly more favourable than the old regime. Now, to give businesses time to adjust to those changes, HMRC have indicated that late penalties will not be issued in 2023, provided the business pays within 30 days of the due payment date. The only other point that I would highlight on this page is that the option to tax, taxpayers are no longer able to request confirmation of options to tax from HMRC unless the option to tax effective date was over 6 years ago, or a copy is needed by a receiver or insolvency practitioner. Now, what this means is that taxpayers, you as charities, need to keep your own copies of options to tax. Now, that's going to become pretty critical when it comes to transactions such as transfers of going concern, where lawyers will no longer be able to request HMRC confirmation, and actually your records will need to do the job. In terms of final points and looking forward, as I noted before, I mean, we're seeing an increased interest by HMRC in the last year, and I expect that to continue. Now, that covers a full range of issues such as the grant treatments, fundraising activities, particularly partnerships with commercial participators and corporate donors, something that Matthew highlighted earlier today, and the use of charity logos. So I think we'll expect a lot more of that going forward. I think the final point here is spring budget in terms of further VAT announcements. Any that are due is due on the 15th of March. Any representations that the sector wishes to make, the window is open until early February. So I'm going to now hand over to Caroline to take us through some of the employment taxes updates.
Okay, thanks, Parol. So good afternoon, everybody. I'm Caroline Jones. I'm an Employment Tax Director based in the Southwest, and as Jill said at the start, I do specialise in working with not-for-profit businesses. So employment tax update, I've got 3 things that I'm going to cover quickly today for you. The impact of the recent holiday pay ruling, home working, and off-payroll, which still is creating some problems for businesses. So we're going to start off by talking about the Harpur v Brazel case. I'm sure many of you will have heard about that, and it is creating a challenge for employers following the judgment. So just to give you a little bit of a background to Harpur Brazel, if you've not heard about it. So Mrs. Brazel was a music teacher based at Bedford Girls' School, and that was operated by the Harpur Trust. So she was engaged under a contract where she only had to work during school term time. So this case relates specifically to part-year workers rather than part-time workers, and I'll explain a little bit more about that as I go on. So her weeks when her hours when she was working varied, depending on the need for her lessons, as you'd expect. So as a part-year worker, she remained employed from year to year, on payroll from year to year, but she was contractually only required to work at certain periods during the year. So this may be something that's happening at your organisation. And basically what's happened with Harpur v Brazel, she challenged the fact that her holiday pay was calculated using a percentage method based on her term time hours. And it's gone through the courts. It was originally heard by an employment tribunal, then went to Court of Appeal, and finally the Supreme Court handed down their decision in 2022. So just want to explain to you what difference that decision may make. So if you were using the percentage method, then basically what you would have probably been doing is, in her case, say she was working 30 weeks a year, earning £150 a week, you would apply a 12.07% to that, and you would come up with holiday pay of £543. As a result of this ruling, you can't do that prorating for part-time workers. So same person, entitled to the 5.6 weeks holiday, still earning £150. Now you would have to pay £840 in holiday pay. So you can see it's significantly different. So basically what we've been seeing historically, particularly actually in higher education, is that employers would calculate their holiday pay based on the percentage method that I've just mentioned, or on a pro rata method to correspond with a working pattern. And neither of these are now applicable, and you need to think about holiday pay and you need to think about your part-year workers. So as I mentioned earlier, the employees are entitled to 5.6 weeks holiday pay. So this case didn't look at holiday entitlement at all. It looked at holiday pay specifically. And this means that even those who work for the part year still have to have 5.6 weeks. Now, of course, if somebody is working part-time as well, so maybe they're working 3 days a week, then you would be able to still give them 5.6 weeks, but that would be based on their pay for those 3 days that they're working. So it's very important that you start to look at your contracts and your arrangements if you do have employees who are engaged on this basis. And we're seeing it across a wide range of employers. So as I mentioned, higher education, we're seeing it in the charitable sector, and we're seeing it in the private sector, where perhaps people are working term time to suit their childcare. So you do now have to think about how you're going to calculate holiday pay going forward, and it isn't something that can be ignored. I think the question is, do we look back? And different employers are coming to different decisions about that, but certainly you need to be thinking about it following that decision back in July. So the impact of the judgment. So what we're seeing our clients looking at is, are you looking at the nature of your contracts? So we are aware of a big retailer who had an arrangement where people were kept on the payroll, even though they were only required to work at certain times. And they decided that they would actually change the contracts and would have a series of fixed term contracts instead. So it doesn't give them any obligation to pay holiday pay for that unworked period. Now, if you do that, that might create a lot of admin for you, but that is one way that you might be able to address it. So looking at your contracts is a starting point. And then, as it says here, interestingly, there was an enforcement body being set up to take responsibility for ensuring that holiday pay was paid. And the National Minimum Wage team were also going into that enforcement body, along with sort of health and safety and various other organisations. But recently it's been announced that that single enforcement body is not now being set up. So we may well see HMRC policing holiday pay, and certainly the way in which you tax that holiday pay. So whilst this is an employment law issue rather than an employment tax issue, it could have a knock-on effect for you from an employment tax perspective. So recommendations are that you start to look at your contracts, think about these individuals, identify those who are affected, and think about how you're going to deal with that going forward. So it's a really quick roundup. We're going to look at working from anywhere. And the reason that I wanted to talk about this working from anywhere, the Office of Tax Simplification published a report in December 2022. They'd looked into the home working arrangements and home as an office, and they've come up with a number of recommendations. So HMRC may be taking an opportunity in the near future to look at the rules surrounding travel and subsistence, where people have got more than one working place. The rules that we've got at the moment have been in place for a long time, probably about 25 years now. So when those original rules were written, of course, working life was very different. So home working arrangements versus home as a workplace. I think it's important to realise that you do need to differentiate between the two from April 2022. But during COVID, we did have a period where HMRC relaxed their rules a little bit. So for 2021 and 21-22, the rules were different and much more relaxed. What I'm going to talk about now is what rules you need to be thinking about at the moment. So home working arrangements, home as a workplace. Why is it important to differentiate between the two? It's because it often causes lots of confusion for employees and employers alike. So if you've got a home working arrangement, I can use myself as an example here. So I work between the office and home. And on that basis, my employer could choose to pay me £6 a week as a flat rate allowance to cover my additional costs. But you aren't able to claim tax relief on that amount if your employer doesn't pay it. And that's what the revenue allowed during COVID. But they've gone back to being very strict about the circumstances in which you can claim tax relief. So if you as an employer want to pay £6 a week to employees who work from home on a regular basis, maybe a couple of days a week, you can do that tax-free. But if you don't pay it, your employee cannot go to HMRC to get the tax relief if they're working under a home working arrangement. So as it says there are a couple of tests. There has to be arrangements between the employee and the employer. That doesn't need to be in writing, and the employee must work regularly at home. And that could be as little as once a week. And if those conditions are met, then you can make the tax-free payments. So let's just go on to the next slide, please. So if we're looking at home as a workplace, this is very much stricter. So when would HMRC accept that an employee's home can be treated as a workplace? Only if substantive duties of employment are performed at home and that there are no facilities available to the employee on the employer's premises. So I've been asked a couple of questions about hot desking. So if you've perhaps reduced the amount of room that you have and people aren't always able to get a desk, does that count? Would HMRC consider you to have home as a workplace? And the answer to that is no. The reason why this is so important is, as I said, we've got the £6 allowance, but also we have to think about travel and subsistence. So are we going to reimburse the costs of travel to work? So if you're working under a home working arrangement, the answer to that is absolutely not. So as I said, you need to have, if there are no facilities in work and your duties, if you're based at home, cannot be performed without the use of the appropriate facilities. The other important thing here is that at no time can you make a decision, can the employee decide whether they're going to work at home or at the employer's premises. So there needs to be a contractual arrangement whereby the employee is based at home and is performing substantive duties at home. HMRC are quite restrictive in the examples they give. So until quite recently, they only talked about puppy walkers for guide dogs for the blind. So they have to work at home and they have to perform the substantive duties at home. So it is quite, as you can see, it's quite a strict test, I think. So if you do meet the conditions as an employee for home as a workplace, then it is possible to claim a deduction for the expenses that you incur and haven't been reimbursed. And as with, home working arrangements, employers can make tax-free payments to cover those additional costs. It is very difficult, I think, to get home as a workplace. Finally, just don't forget about your overseas employees. So we're seeing more and more of that, where perhaps employees are working at home and home is overseas. So you do need to think about these issues on here, on this slide, around permanent establishment, whether you're required to withhold tax in the country where they're living, and all the other sort of social security contributions and benefits that you also need to think about. So appreciate that was really quick, but we're going to go on to off-payroll workers. and how they'll work from April 2023. So the reason why we thought that we would have a look at that is that the intention was that the rules would be repealed, and then they repealed the repeal. So those rules are to remain. And if you are a not-for-profit organisation, you need to make sure that you're caught by these rules. So for some organisations, they won't need to consider it. But what you need to think about is, do you meet 2 out of the 3 criteria listed on this slide? So your turnover is 10.2 million or more. That excludes donations. So that's a really helpful clarification, I think. You've got assets of more than 5.1, sorry, assets of 5.1 or more on your balance sheet. And on an average year, you've got 50 employees or more. If you meet 2 out of those 3 criteria, you do need to think about the off-payroll rules. And they were introduced in April 2021. What we're talking about here is personal service companies. So this isn't individuals. You've always had that obligation to look at individuals to determine whether or not they're self-employed or employees. This is people operating through their personal service companies. And so as it says on here, the new rules, just to remind you, came in April 2021. If you meet that criteria, you have to determine the status and send out a status determination statement to the personal service company. And if you're using an agency in between, also to that agency. You must have an appeal process in place. And really importantly, all your pay-as-you-earn obligations remain with you until you've actually done this. So just really quickly want to pick up on a few of these points because HMRC are focusing on organisations, and I just wanted to raise some of those things that they're focusing on. So around documentation of policies, I was speaking to a client yesterday who's got great process for dealing with off-payroll workers, but it's not documented. And that's something that HMRC will pick up on. So make sure that if you've got a process, you're documenting it. The only other thing I'm going to pick up on is the use of the check employment status for tax tool, which is HMRC's online tool. It doesn't always give a clear decision, and sometimes you have to bring in other factors. So it gives you a set list of questions, but if it doesn't give you a decision, and in 50 to 20% of cases it doesn't, you do have to be consistent and make the decision yourself. So why does it matter? The reason why it matters is because HMRC have taken action against the public sector. And I wanted to bring this out about the public sector because it just demonstrates that they're not just focusing on private sector organisations, but they will actually go after some of their own government departments. So I leave you to read on here exactly how much they've paid, but I just wanted to add the latest case is DEFRA. Not sure whether you've read about that, but £86.5 million DEFRA have had to pay to HMRC because they got their decision making wrong. And in that particular case, they did use that CES tool. So just to conclude, what should you focus on? Make sure that you've determined status at the outset. Make sure you document everything. Make sure you operate real-time information if people are within scope, and have that formal appeals process. So consistency and evidence. And then finally, not going to talk about this, but national minimum wage is going up, as we know, from the 1st of April. It's going up quite significantly, and there are lots of challenges for not-for-profit organisations, not least around volunteers as well. So we are going to run sessions solely for national minimum wage, and I think that's on the 8th of March. So look out for that if you might be interested in joining. And on that basis, I'll finish and hand back to Jill. Thank you, Jill.
Oh, thank you, Caroline, and thanks to Parul as well. It's a really helpful session, lots to think about. We do have a couple of minutes and we do have a couple of questions that have come in. First one for Caroline, going back to your point around casual workers. And the question is, does part-year workers, part-year employees include casual workers who work as and when required?
If you keep them on payroll, so if they've got a continuing contract, but they don't work 52 weeks of the year, yes. If you've just got a short-term contract each time you engage them, then no, you don't have to worry about it. But I think most organisations would have that overarching contract, so they can call on them when they need to. Yeah.
Super. As you mentioned, that balance of kind of admin and could be quite substantial for a number.
Absolutely.
Super. Yeah. Thank you. And Charles would like to know, what's your view of Labour's tax plans on charity schools?
Oh, that's an interesting
question. I think that we're going to see quite a lot of change if Labour do come into power in terms of the private schools. I mean, they've been talking about it though for a long time, haven't they? So what will we see? Will we see sort of exemptions going? I suspect we might see a bit of tweaking around the edges, at least at the start. But I think in the long term, if Labour do come in, then personal opinion, we probably will lose some of the advantages of being registered charities. But that is a personal view. There's nothing out there quite yet that's going to say what they do for definite.
Watch this space.
Absolutely.
And probably the final one, unless anyone has any further questions, probably one for Fiona, because it's a more of an audit question. Mindful of the previous economic presentation that Matthew ran us through, but could you tell us what the latest or current thinking is around going concern considerations from an audit as well as trustees perspective?
Thanks, Jill. Yeah, so interestingly, the new auditing standard on going concern came about at exactly the same time as COVID. So there's often a little bit of confusion around whether the work that we were doing around going concern was enhanced because of COVID, but in reality it was enhanced anyway because of the auditing standard, and that's here to stay. So actually you will continue to get lots of questions from auditors around the basis for going concern, irrespective of the fact that we are emerging from COVID. So I think at the heart of COVID, we were perhaps focused on things like what's happening in terms of investment properties and prices, because the markets were just not performing anything like what we were expecting them to do. So that issue has gone away. But what I would say is that we continue to focus on income assumptions, so building in all the things that Matthew talked about around individual giving, attrition rates on sort of direct debits. Also, trusts and foundations accelerated a lot of their funding during COVID, and therefore I'm hearing firsthand about there being more demand and less supply of those sort of one-off grants from trusts and foundations. So I think everything around your income assumptions needs to be re-looked at in light of the economic environment. But obviously, the cost assumptions are also very critical around where will inflation settle. Charities are large employers, so those payroll-related costs. So I think what we're really looking for in summary is a really strong articulation around what your income assumptions are, but also how you're monitoring those and what indicators you're specifically looking for that might indicate a downward trend, and therefore what your actions are going to be to reduce expenditure to manage your reserves.
Super. Thank you, Fiona. Really comprehensive. And I think lots of focus needed on those scenario planning and those forecasts, as we've mentioned. So we're quite lucky that actually there's been very limited changes to the accounting standards, giving us a little bit more time to focus, for finance professionals to focus more on those financial forecasts. So I will conclude the session. I hope that's been helpful for everyone today. A huge thank you for joining us. Please do fill in the feedback forms when they come through. That feedback is very valuable for us. Thanks for your questions. Thanks for all of your engagement. Many thanks to all of our speakers who have presented and prepared for today's session. Thanks to Hannah for organising us. Have a lovely rest of the day, and wishing you all a very happy and healthy 2023. Thank you.